My name is Mehek Begeman. I'm a CPA and fractional CFO. And on this session, I'm going to cover entity structure for real estate portfolios. We're going to cover tax strategy, cash flow, and exit planning. So it's going to be all meat and potatoes today on this session. I really want to cover this topic in some detail because I see a lot of mistakes in this area. I also see a lot of questions from newer investors in this particular category of questions, which is legal entity structure and how it ties together with tax strategy and to avoid costly mistakes. Now, I did set up this session for more seasoned investors. So if you're just getting started and have one or two rental assets and everything is owned in your personal name, then maybe this is not super relevant to you. If you're planning on scaling, then this might be a little bit of an early, something that you should consume before you set up the entity structures. Essentially, this conversation today is more targeted for investors who have at least five or more assets, and are continuing to scale their portfolio. If you own more than 5 rental properties, entity structure stops being a legal formality and becomes a capital strategy decision. So we're going to tie in, how do you think about this from a long-term buy and hold, 1031 exchanges, refinances, all of those things we're going to cover in this video today. So at scale, the wrong structure really doesn't create minor tax efficiencies. It really can increase your audit risk, can destroy your 1031 flexibility, the conversion of capital gains into ordinary income. I'm going to cover that. Can trap your cash flow, and then last, it can complicate your exits. In this session today, we're going to break down how seasoned investors should think about entity structure from 3 different angles: tax efficiency, cash flow optimization, and then exit planning. Because structure is not just paperwork. It's not just boxes on an org chart. It really is strategy. We want both, right? We want asset protection and we want to be optimized from a tax minimization perspective, which is why this becomes a very important conversation as you are scaling. The mistake that most investors make is that they start with one legal entity. I was actually just having a conversation with one of our clients that started with entity A, and then they've actually been conducting business in this second entity, and they're not really sure what to do with this first entity. I'll just form an LLC. I'll go to LegalZoom or my local attorney, set up an entity, and I'll start doing deals. Beginning of your real estate investing, that's fine because you're just getting started. As you grow, your business becomes complicated because once you add partners, start flipping, you're refinancing deals repeatedly, you've scaled to 5 to 10 plus properties. Now you're raising capital, perhaps, whether that is private money or, equity capital. Now your single member structure does not make a lot of sense. You have a lot of different pieces of activity going on. We have to mitigate not only your risk, but your investors' risk, and make sure from a bookkeeping, accounting, and tax perspective, things line up the way they should. Your entity structure starts impacting these 5 areas, right? So loss deductibility. We're going to talk about that. Debt basis, self-employment tax, dealer classification, and then your partnerships audit exposure. There's something called centralized partnership audit regime that was passed in the recent tax bill. And what does that mean from an audit exposure? What happens in a future year if partners are in and out of a partnership or partnership dissolves and later on has an assessment? We'll cover that in a different topic, but we have to think about entity structures and just ongoing operations of your business. So at this point, the LLC is not just a strategy. It's just a shell. We have to think about how we place activity at different levels for both to keep your attorney happy from a legal perspective and to keep IRS at bay, both from an audit and minimization of your tax. Just as a side note, primarily tackling entity level planning in this discussion here, but we know that under the U.S. tax code and how the tax code is currently written, everything is passed through. So we know that under the current tax code and how the laws are currently written, most real estate is held in pass-through entities like partnerships and S Corps. So the tax burden is actually assessed at the personal level, which is where we do, just overall planning, both at the partnership level and the partner level, the personal level, is that's where we're mitigating the tax burden. So just wanted to mention that. So let's think about rental portfolio strategy. This is for long-term holds. So if that's part of your real estate portfolio, for stabilized long-term rental portfolios, the default efficient structure is usually, it's either a single member LLC, if you're just a single member, or it's you and your wife, a multi-member, taxed as a partnership. Or you've grown to where you have outside partners and essentially you have a multi-member LLC taxed as a partnership. That's going to be the most efficient way. We're going to do pass-through taxation on that LLC, issue the K1s, and like I said, flow all that activity to your personal level. A lot of times they're creating losses in the rental portfolios, which is from where you now create some efficiency on the tax side against all of your other earned income. We do not want an S Corp at this level. Why is that? Because rental income is generally not subject to self-employment tax. An S Corp does not reduce tax on passive rental income, passive meaning from a tax perspective. Some of my landlord friends will disagree, myself included. I also own some real estate in my own portfolio that it's not often rent passive, but from an IRS perspective, it is passive income. In fact, it can create payroll requirements if you were to create the S Corp at compliance costs. It can complicate distributions, and it can interfere with the 1031 flexibility. For long-term holds, simplicity plus basic planning usually wins. We want to keep this activity inside of either a single member LLC or a multi-member LLC taxed as a partnership. So when does S Corps make sense? So S Corps are going to make sense when you are flipping frequently. You're doing at least, 5, 6, 7 flips a year. I like to see continuity in that activity. You're developing property. Maybe you're a builder. With one or two of my clients who are builders that maybe make an earlier selection, they're not profitable just yet. A lot of their projects are still kind of in the capital improvements phase, meaning they're doing a lot of value add to the property. Nothing is really ready to sell yet. You're still triggering your payroll requirement with S Corps. But sometimes it can be a little bit early where they may make the election in year one. I like to wait till we actually have some cash to be able to, make payroll and otherwise. And then the last example would be you're earning active trade income. So I also see some of our property managers, some of our realtors, some of our Airbnb hosts that have active trader income from an IRS perspective make this election, and for it to be a meaningful election for them. And why is that? Because dealer income is ordinary income from an IRS perspective. And an S Corp can do 3 things for us. It can control reasonable compensation. It can reduce exposure to SE tax. That's entirely the strategy to mitigate the SE tax. And it can separate active from investment or passive activity. But here's a critical point. You generally do not want your long-term rental portfolio sitting inside of your dealer entity, which is this S Corp. That's how you accidentally contaminate capital gain treatment, because now you have an entity that essentially just flips. If you have an accidental rental in there, we would have to really steelman your position to make sure we can still get you the capital gain treatment on that asset, and for IRS to not look at all of that activity as dealer or ordinary income. If you have questions on this, please reach out to myself or my team, and we'll be happy to help. So let's talk about dealer versus investor risk, which is a major structural issue in this case. And this is where seasoned investors get into trouble. And from what I've seen with our own client list, if flipping and long-term rentals are held inside of the same entity, and this is what I was alluding to just a second ago, which is you increase your risk in 4 key areas, right? So the first area you have increased risk in is an ordinary income treatment on the sale of a long-term asset, otherwise be able to take the more favorable capital gain treatment on. So let's break that down for just a second. And for ordinary income, trade or business income, flipping income, builder income, you are subject to federal, state, and self-employment tax. You're also taxed up to 39%. Your effective tax rate might be lower than that, but that's the maximum statutory rate under the current tax brackets. For capital gains on the sale of rental assets, long-term capital gains highest rate is 15%. So there's this huge discrepancy between 39% max ordinary income tax rate versus 15%. So you can see where I'm going with this. A capital asset, a buy and hold rental asset, gets much more favorable treatment in comparison to all other types of income. If you are flipping houses, have a property management arm, do construction, so on and so forth. So you see the point I'm trying to make here, which is that can be rolled into another asset at any point in time. If that asset, intent is everything, and that's the gray area, which we like from a tax planning perspective. But essentially, if you have trade or business income, essentially if there was inventory and was held for 6 months, let's say, and there was a lease back in place, it was rented for a short amount of time. If it's inside of this S Corp, it's difficult to make the argument that this is a buy and hold asset that is eligible for 1031 exchange. Now, in contrast, if that asset would have been held inside this 2-member or single-member entity where all other rentals are generally held, and we're going to do a 1031 on that asset, we have a much stronger case to be able to be eligible for that 1031 exchange. The other thing, number 3 risk, was self-employed tax exposure, and then IRS scrutiny. Kind of all tied together. We've talked about this a little bit. In my experience, from what I see with our clients, our sophisticated operators are going to separate their dealer entity, active income, from long-term hold entity, the capital asset treatment, right? So we want to protect the structure, protects the character and the type of the income, which is what we want. And that's where planning comes into play. Now, let's talk about a holding company and where adding a holding company to your entity structure makes sense. So once you scale, your structure often involves 4 the key entity types. We generally will see a holding company at the top. You would see property level LLCs underneath, separate entity for flips, and possibly a separate management. And why do we complicate the structure? Why can't we just keep all activity in 1 or 2 entities? Why would we go through all of these steps to pay an attorney to set this up and then have these additional tax returns? So there's 4 main pieces that make the cost worthwhile for you to have the additional cost of entity structuring and also tax filings. Number 1 would be risk containment. You're containing the risk inside of a legal entity. A lot of times I see clients hold up to $1 million of net worth in one deed LLC, and then they continue to move on to additional asset LLCs. The other thing also is that if you're an out-of-state investor and have assets in different states, then you would have, entities formed in that state. So there's multiple use cases for this, but essentially you want to limit the risk to that legal entity. Number 2 would be debt isolation. So you want to contain that in a specific legal entity. Number 3 would be capital allocation flexibility. And then the last one would be clean exits. If you have questions on this specific piece of it in terms of, what does it mean to have better exits or more efficient capital allocation, so on and so forth, reach out to me. This medium itself doesn't lend to speak to these topics in much detail, but there's enough interest. I will cover that in detail on a following session. Let's be clear. Okay, this is not about complexity's sake. We're not trying to just create a bunch of legal entities and increase compliance costs and, your attorney to maintain all these operating agreements and so on and so forth. It's about controlling the downside risk while preserving the upside optionality of moving assets around, cross-collateralizing, doing the 1031 exchanges, but to be thoughtful. Personally, I generally sit in on meetings with our clients, with their attorneys, so that they have our client, being the one that we're serving, has somebody on the legal side who's thinking about asset protection, and they have us on the tax side, and we're kind of being synergistic in how we're planning and setting up the org chart, the entity org chart, 1, to avoid inefficiencies, and 2, to make sure that there's not some, unforeseen tax things that the attorney may be looking over. They're really sitting in the asset protection seat, and we're sitting in the tax mitigation seat, which ends up being the most favorable outcome for our clients. So let's talk about cash flow implications that most investors ignore. Entity structure does impact cash flow more than you realize. So let's consider the following areas in which cash flow becomes a concern as it relates to entity structuring. So number 1 would be how debt is being allocated is a big one. So this is true for scaling portfolios because now you are starting to hit some metrics with lenders where lendability might be favorable or unfavorable. Number 2 would be who gets basis for losses. This is a huge one, right? So if you have a multi-member partnership, if it's a mother-daughter or husband-wife or, sister-brother partnerships, family, even then, so I think we need to specify how losses get allocated, but especially with unrelated partners, who gets basis for losses, how a capital account's tracked becomes very important. How are distributions treated? Again, getting very advanced on accounting and tax topics, but that is the season of investors scaling your portfolio. These are things that you have to think about. Whether capital accounts are accurate, huge one. See a lot of mistakes here. And then how refinance proceeds are handled. So this is, again, we're going through this with a client right now who has 3 unrelated partners and need to think through how proceeds get handled and partner reporting and so on and so forth. So poor structure can lead to 4 key traps, right? It can trap losses. It can limit the loss utilization. So let's say you have an asset. We do a cost segregation study on it. We kick out a loss. That does not mean that you can receive the benefit of it on your personal tax return. You have to have basis. So your losses can get trapped if you have the wrong structure. Compliance with refinances, we just touched on that, and then reducing deployable capital. So Seasoned investors are modeling after-tax cash flow, not just gross returns. It doesn't do you much good to just look at your top line. At the end of the day, your after-tax earnings is what matters. I'm going to leave you with this. The real stress test for exit planning. This is where I wanted to talk about immediate exit planning perspective. And you can think of this from an asset perspective, it might be 1 to 3 years. From a portfolio perspective, it might be 5 to 10 years. We have a client right now who is in his mid 40s and he wants to be pretty much debt free on most of his real estate by the time he's starting to phase out of active flipping and so on and so forth. Here's a question I ask portfolio investors like yourself that have sizable portfolios. If you sold 3 properties tomorrow, here's the questions that I would ask to stress test your entity structure. Number 1 would be who recognizes the gain, at what rate would be number 2. Are you getting taxed at the highest tax rate or cap gain rates? How much is the appreciation? What does that look like? Are you locked into an asset because of it? Is depreciation recapture isolated? Can you do a 1031 exchange? Number 5 would be, are your capital accounts clean? And then number 6, is dealer status a risk? Answers to these, we're caught in one of these traps, but the question becomes, these are the risks that we've identified. How do we mitigate it? What are strategies that are available to be able to mitigate these risks? If these answers aren't clear, then your structure is not optimized, and then exit planning should be baked into structure from day one, but not saying that we can course correct after the fact. It just takes a little bit more time, maybe 1 to 2 tax years to clean up the entity structure, mark some of the returns final, group the activities together, and onward from there. From my perspective, we're looking at 1 to 3 year strategic planning windows for all of our clients. So entity structure and entity strategy should really align with your current tax burden, with your capital deployment plans, your refinancing timeline, your growth trajectory, which is why here at RE Fund Advisors, we're looking at a 1 to 3 year planning horizon. Certainly are trying to minimize effective tax rate in the current tax year that we're in for our clients. For 2025, that window, that's already closed. Our clients have taken the actions they needed to take. Before year end, they're optimized if they were with us for the entirety of that year, and we had a chance to do planning with them. If you're a new client with us coming on in 2026, then my cadence is 2025. We can do a couple of things, but a lot of strategies have expired, and really 2026 forward looking and focused on how to mitigate 2026 tax burden. The structure itself lends yourself to be able to add partners, transition from flips to wholes, to really prepare for portfolio disposition and or transition altogether. A lot of our clients are not at that phase just yet. We have a lot of clients in their 30s, 40s, and 50s. So a lot of our clients in the building phase of their portfolios, but are structured and are thinking about that transition on what happens if unexpectedly one or both investors, husband, wife, a lot of times the teams are husband, wife teams. What happens if the unforeseen event happens? How does your estate liquidate? So we are giving it some thought. So it's not just left up to chance on the back end of should there be an adverse event. So let me close with this. The real question is, which structure supports the next phase of my portfolio? For seasoned investors, MC design is strategic lever. If you're scaling, refinancing, planning exits, this is worth reviewing proactively and not reactively. If you found this helpful, please subscribe. We'll continue bringing real estate topics from a perspective that, is digestible, makes sense, is action oriented. If you have questions on any of this, please reach out to us. My team is very responsive and we'll get you in touch with us on a discovery call so that we can help you get to the next level and be optimized both from a tax, accounting, and cash flow perspective.